Welcome back to Book Summaries channel. Have you ever wondered why brilliant people make terrible financial decisions while others with modest incomes build massive wealth? Today, we are exploring The Psychology of Money by Morgan Housel, a book that proves doing well with money isn't about what you know, it's about how you behave. In this opening chapter, Housel explains that our personal experiences with money determine how we view the world. People from different generations, backgrounds, and countries have vastly different views on risk and reward based on the economy they grew up in. Someone who grew up during the Great Depression will view the stock market differently than someone who grew up during a bull market. We all make financial decisions based on our own unique experiences that seem perfectly logical to us at the time. This means that no one is actually crazy. They are simply operating based on their specific life map. Wealthy people might take risks that seem insane to the poor, and the poor might spend money on lottery tickets that seem wasteful to the rich. Each group is trying to solve a problem with the tools they have. Understanding this helps us be less judgmental and more analytical of our own biases. It reminds us that financial success is less about intelligence and more about the environment that shaped us. We must realize that our own view of money is just a small slice of reality. Luck and risk are the siblings of financial outcomes, yet we often ignore luck and overemphasize risk. Every outcome in life is guided by forces other than individual effort, and luck is simply the realization that the world is too complex to be 100% in our control. Housel uses the example of Bill Gates, who attended one of the few high schools in the world with a computer, which was a massive stroke of luck. Conversely, risk is the flip side of that same coin, where things go wrong despite your best efforts. We tend to attribute our own successes to hard work and our failures to bad luck, while doing the opposite for others. This chapter teaches us to be humble when things go right and compassionate when they go wrong. Focus less on specific individuals and more on broad patterns of behavior that are repeatable. By acknowledging luck, we can avoid the trap of thinking we are invincible during good times. By acknowledging risk, we can stay the same course during bad times. The key is to find strategies that survive both luck and risk. The hardest financial skill is getting the goalpost to stop moving. Many successful people fall into the trap of social comparison, constantly looking at those who have more and feeling inadequate. This leads to taking unnecessary risks with money they need for money they don't even have a use for. Housel shares stories of millionaires who committed fraud because they weren't satisfied with their current wealth. The ceiling of comparison is so high that virtually no one will ever reach it. Happiness is simply results minus expectations. So if expectations keep rising, happiness remains elusive. You must define what enough looks like for you and stick to it, regardless of what your neighbors are doing. There are many things never worth risking, no matter the potential gain, such as reputation, freedom, and family. Wealth is not just about having a lot. It is about knowing when you have sufficient to meet your needs. Discipline is the only thing that keeps the goalpost in place. Without enough, you will always be a slave to the next dollar. Compound interest is the most powerful force in finance, but its results are not intuitive to the human brain. We think linearly, but compounding grows exponentially, meaning the most significant gains happen at the very end. Warren Buffett is a prime example. Over 90% of his wealth was accumulated after his 65th birthday. He wasn't necessarily the greatest investor ever, but he started young and stayed invested for decades. The secret to wealth is not necessarily high returns, but consistent returns over a long period. Many investors fail because they try to swing for the fences and end up losing their principal. If you can simply stay in the game without being forced to sell, the math of compounding will eventually do the heavy lifting for you. It requires extreme patience and a willingness to be bored. The goal should be to earn pretty good returns that you can stick with for the longest period of time. Time is the most important variable in the wealth equation. Compounding only works if you give it the years it requires to bloom. Getting wealthy requires taking risks and being optimistic, but staying wealthy requires the exact opposite: humility and paranoia. Many people go broke shortly after becoming rich because they don't change their behavior to match their new situation. Staying wealthy is about survival and ensuring that you are never forced to sell during a market downer. You must have a barbell personality where you are optimistic about the long term but terrified of the short term. This means keeping enough cash on hand to weather any storm without touching your investments. Survival is the only thing that matters in the world of compounding. If you get wiped out once, all previous gains are irrelevant. You have to be able to survive the unsurvivable events that occur every few years in the economy. Financial success is more about avoiding mistakes than it is about making brilliant moves. Being unbreakable is the highest form of financial status. You must plan for the plan not going according to plan. In finance and business, a tiny minority of events drive the majority of outcomes. These are called tails. This means you can be wrong half the time and still make a fortune if your few big wins are large enough. Most stocks in an index fail, but a few giants like Amazon or Apple drive the entire market's returns. Similarly, an investor's career is often defined by just a handful of great decisions rather than hundreds of average ones. This realization takes the pressure off of being right every single time. It is perfectly normal for most of your investments to be mediocre or even losers. The key is to not let the losers destroy you so that you are still around when the tail events arrive. We often admire the genius of successful people without realizing they were just the beneficiaries of a tail event. Focus on the fact that failure is a normal part of the process. If you stay diversified, you give yourself more chances to catch a tail. Success is about the cumulative result of your entire portfolio, not any single line item. The highest form of wealth is the ability to wake up every morning and say, "I can do whatever I want today." Money's greatest intrinsic value is the control it gives you over your time. Research shows that having a sense of autonomy is a stronger predictor of happiness than income level or house size. Even if you have a high-paying job, you will feel miserable if you have no control over your schedule. Wealth allows you to wait for the right opportunity, quit a job you hate, or retire when you choose. It provides a buffer against life's unexpected demands and gives you the freedom to choose your associates. Many people use their money to buy status symbols, which actually decreases their freedom by locking them into higher expenses. If you use money to buy time, you are using it for its most efficient purpose. True freedom is not about being lazy. It is about having the power to choose your work. Money is a tool to design a life that makes you happy. Controlling your time is the ultimate dividend that money pays. When you see someone driving a luxury car, you rarely think, "Wow, that guy is cool." Instead, you imagine yourself in that car and think people would find you cool. This is the man in the car paradox. We use wealth to signal to others that we should be liked and admired, but those people are usually just using your wealth as a benchmark for their own desires. They aren't looking at you. They are looking at the car. This chapter highlights the futility of using material possessions to gain respect or admiration. True respect, humility, and kindness are far more effective at building relationships than a fast car or a big house. We often spend money we don't have to buy things we don't need to impress people we don't like. If your goal is to be admired, realize that expensive things won't get you there. People are inherently self-centered and will always focus on their own reflection in your shiny objects. Wealth is what you don't see. The car's not purchased and the diamond's not bought. Focus on building character rather than buying status symbols. Housel draws a sharp distinction between being rich and being wealthy. Richness is current income. It is visible in the cars people drive and the clothes they wear. Wealth, however, is the income that is saved and invested. It is the options not yet taken. Wealth is the hidden part of the iceberg that provides security and flexibility. It is very easy to find rich role models because their spending is loud and visible. It is very hard to find wealthy role models because their success is quiet and tucked away in bank accounts. We tend to judge financial success by what we see, which leads us to copy the spending habits of the rich rather than the saving habits of the wealthy. Staying wealthy requires a level of self-control that stops you from spending the money you have. True wealth is the ability to withstand a job loss or a medical emergency without panic. It is the money that didn't turn into stuff. To build wealth, you must suppress the urge to show people how much money you have. Wealth is the potential energy of your future. Building wealth has little to do with your income or investment returns and everything to do with your savings rate. You can build wealth without a high income, but you cannot build it without a high savings rate. High returns are often out of your control, but how much you spend is entirely within your control. Savings is the gap between your ego and your income. If you can learn to be happy with less, you create a massive advantage for yourself. This chapter argues that you should save money even if you don't have a specific goal like a house or a car. Saving for the sake of saving gives you optionality and margin of safety in an unpredictable world. It allows you to take risks or pivot your career when others are stuck. In a world where intelligence is becoming a commodity, the ability to be flexible is a competitive edge. Savings provide that flexibility. You don't need a reason to save. You just need to realize that the world is full of surprises. Every dollar saved is a piece of your future freedom. In the world of finance, being reasonable is often better than being coldly rational. Humans are emotional creatures, and a strategy that is mathematically perfect but emotionally unbearable will always fail. For example, it might be rational to have no bonds in your portfolio, but if that causes you to panic and sell during a crash, it wasn't a reasonable plan. A reasonable plan is one you can stick with even when things are going wrong. You should aim for a strategy that lets you sleep well at night rather than one that maximizes every cent. This might mean paying off your mortgage early even if the interest rate is low, simply because it gives you peace of mind. Investing is not a math competition. It is a game of endurance. If being a little irrational helps you stay invested for 30 years, then it is actually the most reasonable thing to do. Don't try to be a spreadsheet. Try to be a human who knows their own limits. Logic is great, but psychological comfort is what keeps you in the game. Success is staying the course. The history of the economy is a record of unexpected events that nobody saw coming. Using the past as a strict guide for the future is dangerous because the once-in-a-century events happen all the time. Housel warns against over-reliance on historical data to predict future market returns. The most important events in history are the black swans that break all existing rules. The future will likely look nothing like the past because the world is constantly evolving. Instead of trying to predict the next crisis, you should prepare yourself to handle any crisis. This means having a large margin of safety in your finances and not being over-leveraged. History is a study of change, not a map of what will happen next. You must leave room for error in your planning for things that have never happened before. The most dangerous phrase in finance is, "This time is different," but the second most dangerous is, "This is how it has always been." Expect the unexpected and build your life around that uncertainty. The most important part of every plan is having a plan for when the plan isn't going according to plan. This is the concept of margin of safety. You should never be so optimized that one bad break wipes you out. In investing, this means assuming that your future returns will be lower than historical averages and saving accordingly. It also means not using too much debt, which removes your room for error. A margin of safety allows you to survive a range of outcomes, both good and bad. Many people fail because they have single points of failure in their lives, such as relying on one income or one investment. You need to build a life that is anti-fragile, where you can withstand volatility without breaking. The gap between what could happen and what you need to happen is your safety net. The bigger that gap, the more likely you are to succeed. Success is about endurance, and endurance requires a cushion. Never bet the farm on a sure thing, because there is no such thing. Humans are poor at predicting their future selves. Our goals, desires, and values change as we age, which makes long-term financial planning difficult. The end of history illusion is the belief that we have finally become the person we will be for the rest of our lives. Because we change, we should avoid extreme financial commitments that lock us in. A career you love at 20 might be one you hate at 40. A house you thought was perfect at 30 might be a burden at 50. Housel suggests aiming for balance in your life to minimize future regret. Don't work so hard that you ignore your family, but don't save so little that you have no security. Middle-of-the-road strategies are often the best because they allow for the most flexibility as your personality evolves. Accept that you will likely change your mind about what you want. Give yourself the grace to pivot and the financial flexibility to do so. Your future self will thank you for not making permanent decisions based on temporary feelings. Everything in life has a price, but in investing, the price isn't on a price tag. It's in the form of volatility, fear, and uncertainty. Successful investing requires you to pay this price day in and day out. Many people see market downturns as a fine or a punishment for being wrong, but they should see them as an admission fee. The price of earning high long-term returns is the gut-wrenching feeling of watching your portfolio drop 30% in a month. If you can view this as a fee rather than a fine, you are much more likely to stay invested. People who try to avoid the fee by timing the market usually end up paying a much higher price in lost returns. There is no such thing as a free lunch in the markets. You cannot get the reward without accepting the risk and the emotional toll. Accepting the price of admission is the first step to becoming a successful long-term investor. It changes your perspective from victimhood to participation. Pay the fee gladly, knowing it's the cost of your future wealth. One of the biggest mistakes investors make is taking cues from people playing a different game. A day trader has a completely different set of priorities and right moves than a 30-year long-term investor. If you follow the advice of someone with a different time horizon, you will likely make decisions that are wrong for your specific goals. For a day trader, a stock might be a buy at any price if it's moving up, but for a long-term investor, the valuation matters. Housel warns against financial bubbles, which often happen when long-term investors start following the momentum of short-term traders. You must be clear about what game you are playing and ignore the noise of those playing others. Don't be swayed by what's popular on social media or the news. Your financial goals are personal and unique to you. Determine your own time horizon and stay true to it. Comparing your inside to someone else's outside is a recipe for disaster. Play your own game. Pessimism sounds smarter, more plausible, and more urgent than optimism. If you tell someone that a recession is coming, they will listen intently, but if you tell them things will get better, they will likely dismiss you as naive. We are evolutionarily wired to pay more attention to threats than to opportunities. However, the history of the world is one of long-term progress interrupted by short-term setbacks. Optimism is the belief that the odds are in your favor and that, over time, things will trend upward. Pessimism is seductive because it feels like it's protecting you, but it often prevents you from participating in the massive gains of the tail events. Realize that progress is slow and quiet, while disaster is fast and loud. Don't let the headlines scare you out of a sound financial plan. It is easy to be a pessimist because the news is designed to be negative. It takes courage to be an optimist in the face of constant negative noise. The rewards for long-term optimism are immense. We are prone to motivated reasoning, where we believe things are true simply because we want them to be true. This is especially dangerous in finance, where the desire for high returns can lead us to believe in get-rich-quick schemes or unrealistic predictions. We create stories to explain a world that is largely random and unpredictable. This gives us a false sense of certainty and control. Housel points out that the more you want something to be true, the more likely you are to believe a story that supports it. This is why people hold on to failing stocks or fall for guru advice. You must be aware of your own blind spots and the stories you tell yourself to make sense of the market. The world is far more complex and messy than any narrative can capture. Accept that there is much you don't know and can't predict. Humility is the best defense against the seduction of a good story. Question your own beliefs, especially the ones you are most attached to. In this chapter, Housel summarizes the key lessons of the book. He emphasizes that money management is more about behavior than math. He suggests finding humility when things go well and compassion when they don't. Manage your money in a way that helps you sleep at night, which is the ultimate test of a financial plan. Increase your time horizon, as time is the most powerful force in investing. Become okay with being wrong half the time, as tails drive everything. Use your money to gain control over your time, which is the most valuable thing money can buy. Be nicer and less flashy, as no one is as impressed with your stuff as you are. Save for no reason at all, just for the sake of optionality. Define the cost of success and be willing to pay it. These principles form a cohesive philosophy for navigating the psychology of money. It's not about being the smartest person in the room. It's about being the most disciplined and self-aware. In the final chapter, Housel shares his personal financial choices, emphasizing that what works for him might not work for everyone. He values simplicity and low stress over maximizing every possible dollar. He and his wife own their home outright and keep a high percentage of their net worth in cash, even though it's irrational from a pure investment standpoint. He invests exclusively in low-cost index funds and doesn't try to beat the market. His goal is independence and to never have to think about money. He admits that his strategy is tailored to his specific psychology and desire for peace of mind. This confession serves as a reminder that there is no one right way to handle money. You have to find a system that aligns with your own values and temperament. Don't copy others. Find what makes you feel secure and free. The best financial plan is the one that allows you to live your best life. Your psychology is the most important part of your portfolio.